Good. So we're live? Good morning, everyone.
Good morning.
We are here. Senator Klausmeyer, go ahead.
Thank you, Delegate Carey. Good morning, everyone. Good morning, Delegate Carey, especially. We were saying it in unison. We are the co-chairs of the Joint Committee on Unemployment Insurance Oversight, which has been a very popular topic over the last, unfortunately, 2 years. It's the gift that keeps on giving with the COVID and all the other things that go along with COVID or that have gone along with it. But we just want to bring the public up to speed on what's going on as far as unemployment insurance. And so that is why we're having this meeting today. And from that, I'm going to let Delegate Carey say a few words, and then maybe just go around and everybody can introduce themselves.
Okay, thank you. First of all, Happy New Year to everyone. I hope that this year we can start to put all of this behind us. But as Senator Klausmeyer said, yeah, this seems to be the gift that keeps on giving. But we're here today to talk about the reports that we had done, namely the study that looked at the UI system. And we're also here to talk about where we are with the legislation that we passed with the department, and just hear an update from the department. So with that, if you want to go around and introduce ourselves on the call. Again, I'm Delegate Carey, co-chair of the committee, of the Oversight Committee. And Delegate Charkoudian, let me just say this.
Yes.
Too. I'm sorry. I wanted to welcome Delegate Charkoudian.
Right.
Delegate Lord Charkoudian is the newest member to the Joint Oversight Committee. She's also the chairwoman of the subcommittee on unemployment insurance. And I'd also like to thank Chairman Wilson for his past role on the Joint Oversight Committee. So with that, Delegate Charkoudian, we'll start with you.
Great. Good morning. Thank you. I'm honored to be here, excited to be here. Lots of work to do, and I'm looking forward to working with everyone on this call and beyond to continue to strengthen our unemployment insurance system. And Happy New Year to everyone. Do you want me to pass it to the next person, Senator Klausmeyer?
Yeah, sure. Mr. Klein is just looking at the picture. So.
Thank you, Senator. My name is Ken Klein. I'm a senior research analyst at the Upjohn Institute in Kalamazoo. Good morning, everyone. And it's been great as a researcher to work with all the data from Maryland to produce these reports. And I thank you for the opportunity.
Thank you. I'll go over here. Andrew.
Good morning, everybody. Andrew Griffin with the Maryland Chamber of Commerce.
Okay. Secretary, I'm just looking at the pictures.
Sure, Senator.
Secretary Robinson.
My name is Tiffany Robinson. I'm the secretary at the Maryland Department of Labor. It's a pleasure to join everyone this morning.
Okay, Mike O'Harrelling.
Hey, good morning, everyone. Mike O'Halloran, State Director for National Federation of Independent Business. Thanks for having this meeting this morning. Happy New Year, everyone.
Sure. Mike Sears.
Hi, everyone. Mike Sires. I'm the economist for the Maryland Department of Commerce. So
okay. Andrew Finn.
Andrew F.
Okay. You just already said it. There's my other Andrew.
That's right. I'm right here, Senator. Good morning, everyone. Happy New Year.
You popped up there.
Andrew Fulgeniti, Legislative Director for the Department of Labor.
Kaylee.
Good morning, everybody. Kaylee Locklear, President of the Maryland Retailers Association.
Oh, and Donna Edwards.
Good morning. This is Donna Edwards. I'm President of Maryland State and DC AFL-CIO.
And Chris O'Leary.
Good morning. I'm Chris O'Leary. I'm an economist at the Upjohn Institute for Employment Research, and happy to be with you to share our results. this morning.
Okay, Steve Ross.
Good morning, Steve Ross, DLS staff for the Joint Committee.
And Council Laura Addis.
Good morning, I'm Laura Addis. I'm counsel to Economic Matters and staff to the Oversight Committee.
And I'm just going to pop in here and say this is her last meeting with us because she is taking a position in the Treasurer's Department. She's going to be Deputy Treasurer. So watch your pennies, right?
I miss her.
Thank you, Senator.
Very much so. Very much so. Nathan.
Good morning, Nathan McCurdy, counsel to the Finance Committee and staff to the Oversight Committee.
Erica.
Good morning, Erica White. I will be replacing Laura's counsel to Economic Matters and staff to the Oversight Committee.
Okay, and Senator Benson, welcome. Just say hi.
Hello, everyone. Good morning.
Well, you don't look like Senator Benson, but you'll know.
Good morning, everybody.
Where is she? Oh, there she's up there now. Okay.
Good morning.
Good morning. Okay. Do we have everybody? Annie from DLS?
Hi, I'm just here to make sure the Zoom runs smoothly.
Oh, okay. All right. Okay, so then we can begin, and you want to put that up there. We're having a briefing by the Maryland Department of Labor and work at WE Upjohn Institute for Employment Research on the study of system reform required under Chapter 45 and 46 of 2021. And we will start with the Upjohn Institute with Mr. O'Leary and Mr.
Klein.
Yes, got it. Okay, thank you. You guys take it away.
Thank you, Senator Klaus Meyer. It's a privilege to be here this morning to meet with you and share the results of research that we've done in cooperation with the Jacob France Institute at the University of Baltimore. We're very pleased to be working on this. Unemployment insurance is one of the main topics that the Upjohn Institute has studied for more than 80 years. And, you know, the example of Maryland is an excellent one to work on. And the problem of financing is one that all states are grappling with. The claims report came out this morning from the U.S. Department of Labor. And last week, well, the week of January 1st in Maryland, 3,639 people applied for benefits. That's a stark contrast to the week of April 4th in 2020, at the beginning of the pandemic, when 107,000 Marylanders applied for benefits. The agency has done an amazing job, and probably in 2020, the Unemployment Insurance Agency was one of the most important entities in the state of Maryland. During that time, there was a new computer system installed. The system worked better than it could have without that new system, but many challenges were faced. And there have been many responses, including by Governor Hogan issuing executive orders and by actions taken to buttress the trust fund. We try to take all these things into account, and I thank you for your attention. Most of my experience is giving academic seminars and teaching college classes, and I know I've got a very bright group of people here, and I thank you for your patience, and I'd like to go through some ideas that we have, or at least evidence that we have. We just want to provide some evidence for you to look at the situation and try to decide the best way going forward for restoring unemployment insurance in Maryland. I'm going to share my screen, and have I shared? I'd like to share my screen so I can control it. Is that possible?
Yes, I can make you a co-host. Hold on.
Okay.
And Chris, will we get a copy? Can we get a copy of these?
There is a copy. I think your colleague has a copy. We email Laura Atas.
Oh, okay.
Copy
All right.
Yeah.
Okay. Thank you.
Okay. I'm waiting for the enable my screen sharing so I can go through this quickly.
Annie, are you able to make him a co-host? I don't know if we have too many. It's not allowing me to do it.
I think I can. 1 second.
I should have requested that at the start.
All right, he should be co-host now.
Okay, great. There we go. Here we are. All right, so here's a little outline. I want to give you a little background on the Maryland UI system benefits and financing. What are considered to be standards for adequate benefits? The committee requested examination of several issues, and one of the big ones was improving benefits. Cost, what would be the cost for improving benefits? And we've looked at standard rules for benefit adequacy and figured out the cost in Maryland for those. The issue of a regressive tax has come up, so we want to just mention what that is. We have a baseline simulation that accounts for all the actions that were taken in 2021. And then we look at some simulations indexing the taxable wage base. We have information on the 19 states that actually do index and the fact that their reserves tend to be more stable over time. Eliminating tax Schedule A was one of the things that was considered, whether that was a too low of a rate. And then we estimate the cost of improving benefits. We raised the prospect and we did some analysis to consider giving employees, workers, more stake in the system. We know that businesses pay directly the taxes, but employees pay indirectly already through lower wages, somewhat lower wages, research suggests. But what about direct employee taxes for unemployment, like in New Jersey or in Pennsylvania? And we've simulated a rate less than New Jersey and somewhat higher than Pennsylvania, somewhere in a very modest range, with the lowest rate that any Maryland employer pays, which is 0.3%. And of course, the important issues that came to the fore during the pandemic about preventing fraud and errors and improving accuracy as well as access to the system. Let's see here. Trying to find out. There we go. Let's see. There we go. Okay, the weekly benefit amount in Maryland replaces 54% of high quarter base period earnings up to the maximum. That's a higher wage replacement rate than is recommended by research, only slightly higher. The research suggests 50%. Historically, the maximum was increased every 3 or 4 years, but it hasn't been increased from $430 since 2010. This morning, Ken Klein did some computations on the database that we've been working with, which is claims in Maryland between 2016 and 2020. And we see that in 2019, 50% of Maryland beneficiaries were at the maximum. That means half of the people were not getting that 54% wage replacement because their earnings were higher. The minimum weekly benefit amount has been the same, $50 for many years, but it could be indexed as well. And we look at some simulations for indexing the minimum. And we also look at the dependence allowance, which has been $8 per dependent for 30 years. This graph shows what the maximum is over time since 1970. It was slightly over $50. Now it's $430. But the average you see of these gray bars follow the maximum. And maybe I can make this a little bit bigger. If I can move this, no, I'm not. View full screen. Is that working? Okay, yeah, there we go. And the minimums you see in red down here, and the dependence allowance all on this graph. The average benefit amounts as a share of average wages in Maryland have declined from about 40% to about 30% between 1970 over the 50 years from 70 to 2020. And the maximum as a share of average wages in the state has fallen from about 47 to below 40%. The financing in the state has been very slow to adjust to change. The taxable wage base matched the federal minimum standard of $6,000 up to 1983, when the federal standard was raised to $7,000. And then in 93, it was raised to $8,500. That's the last time it was changed. So that's what, 29 years ago, the taxable wage base was changed. And what's happened is that as a proportion of total earnings in the state, the unemployment, the earnings subject to the unemployment tax has declined from about 50%, and then it was spiked up to 42% here in 83, declined, spiked up to 32%. Now only 14% of taxes are subject to unemployment insurance. 14% of earnings are subject to unemployment insurance tax. That's a very regressive system that bears more heavily on low-wage workers. Where does Maryland stack in terms of average tax rates? Well, it's in the bottom quarter, about 4 on average in 2019. We looked at this pre-pandemic to get a better picture. Around 4.2%, 0.42% of 1%. And in terms of taxable wage base, it's in the bottom 20% of states. It's like almost at the bottom. This is what I'll be talking about shifting between tax schedules. And this is the way the tax schedules in Maryland look. There's 6 tax schedules, and there are triggers that jump between these tax schedules. The lowest rate for any Maryland employer is 0.3%, and the highest is 13.5% on the highest Schedule F. You hear about Schedule F and Schedule A. This is what they look like on a graph. This is what taxable wages look like in the state. The bulk of taxable wages are at the minimum rate. This is about $5 billion in earnings in 2019 at the minimum rate. And you can see the chunks of earnings. The next chunk is about $1.5 billion. This is about $2.5 billion. And most employers are clustered near the bottom of these distributions. And then we talk about triggers, and we've done a bunch of simulations, and Secretary Robinson will tell you that in addition to the 4 reports and supplementary memo that were circulated, we also did an additional analyses. We had a macro simulation report in January of last year, and another micro simulation report in July of last year. And we did simulations of what the triggers could be jumping between these schedules. What are the standards for adequate benefits? 50% of prior earnings is sufficient to balance adequate income replacement with work incentives. The maximum benefit should be 2/3 of the average wage. That ensures 80% of beneficiaries get 50% wage replacement. Right now, only 50% of Maryland beneficiaries are getting 50% or 54% wage replacement because the maximum is lower than would accommodate enough people getting 50% wage replacement. Could also index the minimum to average wages. And average wages in the state of Maryland are about $1,100 a month, about $60,000 a year. You do provide 26 weeks of benefits, which meets the standard, and it's enough time for people to do a good job search for matching. This is the way the system currently works. 54% of high quarter earnings, 1/24. So there's 13 weeks in a calendar quarter. So 13 over 24 is 54%. Times that high quarter, it gives you about 54% of the average earnings in a week where you're probably working full time or your highest usual hours. The dependence allowance is 8. It's capped at 40. The maximum is 430. The minimum is 50 and 26 weeks. Options for reform that we look at are actually somewhat lowering the replacement rate, so it's 50%, and see whether or not that pays. And it does pay for increasing the dependence allowance and improving the minimum. Of course, raising the maximum has a cost, and we provide an estimate of that cost. These are the costs. So right now, under the current system, this would be the maximum of 2/3. And so this would be, Ken, is this the, oh, this is the baseline. This is the cost of benefits paid in 2019 under the current arrangement. If we change the formula for the maximum or for the replacement rate, the average weekly benefit amount would go up this much.
Chris, if I may interrupt.
Do we include all the simulations there, Ken? Is that what we did?
That one, the replacement rate does not change in that row. It's increasing the maximum.
Oh, that's just increasing the maximum in that row.
Correct. Keeping the 54%.
Right. That's right. So this is if we increase the maximum and we keep the replacement rate at 54%, the system cost would go up by 37.6. Hasn't been done in 28 years. If we lowered the replacement rate to 50%, the cost of raising the maximum to 2/3 of the average weekly wage would be about 30%. So it saves about 7.7%. And then if we, let's see, this is with the 50% wage replacement and raising the minimum, indexing the minimum, it goes up slightly. The cost is a percentage, the increased cost, and improving the dependence allowance. So with all the changes, the dependence allowance and the increased minimum, the cost goes up 34%, and it's less than, and because we switched to 50% wage replacement, it's less than just raising the maximum. So what is a regressive tax? A regressive tax bears more heavily on those with lower incomes, lower wages, and fewer hours worked. A low fixed taxable wage base bears more heavily on employers paying lower wages and low wage workers. Employers pay UI taxes directly, but workers pay through lower wages. A low fixed taxable wage base bears more heavily on low wage multiple job holders who have paid the tax on every job. So if people have 2 or 3 jobs where they're trying to scrape together a living, wages, taxes are paid on every single one of those jobs. And many times low wage workers have a hard time accessing the system. So they might have paid in 2 or 3 times and they don't get benefits when they're out of work. Low taxable wage base could induce employers to expand hours for workers who have exceeded the taxable wage base threshold, workers who've earned more than the $8,500, and maybe they didn't hire additional workers because they can add hours for people already above the threshold instead of hiring new workers where they pay the tax on the first dollar. The baseline economic assumptions are these in terms of growth for 21 relative to 20. Those fit with where we actually ended up at the beginning of 22. The annual growth returns to more normal in 22 to 23. So we changed the assumptions in the model in terms of labor force growth, employment growth, covered employment growth, and average wage growth. The unemployment rate gradually declines from, we assume, from 5.5% in 2025 to 5% in 2028 to 4.4% in 2032. We need to have some assumptions, and these are consistent with what economists generally think is going to happen. The baseline assumptions, like I said, were the existing system, but we also account for the non-charging of benefits during the pandemic, and we do that by adjusting the tax rates to adjust revenue. And the cash infusion of $1 billion that was made last year, we also take that into account. So where are we going here? So right now, with the taxable wage base of 8,500, revenues this year, we project at 461, some interest income. You can see this jump here from 21 to 22 in terms of the trust fund year-end balance. Is about $1 billion. And this is the average high cost multiple. Now, the adequacy of reserves is judged by this high cost multiple. That is, how many years could you pay benefits with the reserves you have if you're paying benefits at the recession level? That is, the average in the last 20 years of the highest payout rate. And what this says is that you have 1.12 on hand. The standard that the Department of Labor has put out for interest-free borrowing from the Treasury for short term is a high cost multiple of 1.0. And actually in your statute in chapter 8-612 paragraph F, you say that if the I cost multiple is less than 1.0, you cannot move to a lower tax schedule. So if we leave the system as is and we don't increase benefits or anything, the system will actually start to bleed funds because Schedule A is not enough to maintain that 1.0, but there's nowhere to go lower. So paragraph F does not force any action here. So in terms of long-term stability, the fund is headed for a decline. Let's suppose that we just started with the 8,500 and indexed it starting in 2023 to wage growth. If we did that, and the actions that were taken to infuse reserves guarantee that employers in Maryland will be paying on Schedule C in this year and next, but indexing will also not be sufficient if we simply start at $8,500. Raising the taxable wage base by $1,500 to $10,000 and then indexing it thereafter looks a little bit better. And of course, though, we haven't increased benefits at all in this. And I think that's one of the things that the committee wanted to look at, improving the benefit adequacy of the system. And so we need to still consider raising revenue to improve the system for Maryland workers and employers. So if we indexed it to 25%, which is one of the simulations that we present, starting in 2023, yes, the taxable wage base would jump in that year to 16,400. And by 2032, it would be 20,000. But it would keep employers on the lowest tax schedule, and it would raise revenues that would be sufficient, we found, to pay for the benefit enhancements that we've considered. Now, remember that in 1983, 42% of average wages were taxed, 32% in 93 and 14% now. This would still be Ken, where's that number? It's not on this table.
What's that? What number?
The percentage of total wages that this would be. I think we show it later. Anyway, remember that unemployment insurance was started under the Social Security Act, and we all know that the Social Security taxable wage base is much higher. It's 140 some odd thousand. And the Social Security taxable wage base applies to 94% of all earnings. In 2019, 14% of earnings were taxed. This would raise it, and we have that number later.
It's to 25.
It's 25%. So this exhibit shows the states that have indexed taxable wage bases. And you can see that actually a couple of states, Hawaii and Idaho, consider the whole taxable average tax annual taxes 100%. The lowest that any index state has is 46.5. That's Rhode Island. Vermont actually raised their tax base and then just indexed it from there. So the legislature could decide to go to 10, to 12, to 13 and index it from there. That's another approach. But no state has an index tied to the average as low as 25%, although our simulations suggest that would be a great improvement. So the fix is regressive. There's evidence that published in the National Tax Journal, these states all have better reserve positions. A couple of them have had difficult economies, but all of these have higher than one. Almost all of them have higher than one average high cost multiples. States with better reserves also pay better benefits. So in terms of the micro simulation to index the taxable wage base, how does it affect Maryland employers? And we have a lot of detail on the industries and the average wages and so forth, but in aggregate, taxable wages that would be covered, the increase would be 54% on average for Maryland employers, and then the small and medium that have 50 or fewer employees would be slightly bigger. The benefit ratios for these, when you raise the denominator, so you have a benefit ratio experience rating system, which is benefit charges divided by taxable wages. And when you increase the denominator, you lower the numerator. So in a sense, you're lowering the experience rate for all employers by increasing the taxable wages by 31.5%. So tax rates actually go down. So those tax schedules that I showed you, all Maryland employers are moving down those tax schedules. But because the tax base goes up more than the tax rates go down, the product goes up. And it goes up 20.7% on average for experience rated employers and 25.3% on average for small and medium employers. That amounts to $31 per employee increase, or $32. And the bulk of small and medium employers are 1 and 2 employee shops. So that would mean, $32 or $64. That's, I think, 20% of all the employers in the state would be facing something like that in terms of an increase. And actually, when you look at, we have results later by employer size, the larger the employers, typically the cost per employee declines if you look at it. This is just a graph that compares the different simulations that we ran. The baseline is not sufficient. Indexing at 8,500 is barely reaching this 1.0 average high cost multiple. If you jump to 10,000 and index, you're going to do okay, but you can't pay for benefits. This was a 20% indexing. This is the 25%. So the benefit improvements that we consider, we already talked about, raising the maximum, indexing the minimum, increasing the dependence allowance. We look at the cost of these if claims were the same at the lower values of these parameters. And then we consider the fact that a higher replacement rate for some beneficiaries might lengthen their durations. So we add that behavioral response in our costs. This is what the average benefits would look like. The average weekly benefit amount in the simulation currently looks like this. It's $342, and it will go up to $384 under your current rules. If we index the maximum to 2/3 of the average weekly wage, the maximum would go, the weekly benefit amount, the maximum would go like that. The weekly benefit amount would go like this. It's $322, and it would diverge right here. We suggest that it happens in 2023. It would jump to 504 average, and it would increase to 666. And then if we increased and we added an indexed minimum, the average benefit amount would go to, in 2023, to 511. And then if we improve the dependence allowance to 520, that's the average benefit amount. This is a simulation of if we had an index taxable wage base set at 25% of the average annual wage, and we made all those increases in benefits, what's the financing situation? And we did it with no behavioral response. This is how revenues would be. This is how the dollars paid out, and this is including a behavioral response. The cost is slightly higher with the behavioral response. The year-end trust fund balances are these, and the average high cost multiple are these. So if there's no change in behavior, the average high cost multiple would be that. And so this just shows that if you index the taxable wage base starting in 2023 to 25% of the average annual wage, it would pay for these benefits, and it would keep employers over the long term on the lowest rate schedule. So you'd be allowing the system to work. So if there was a proposal, what about eliminating tax Schedule A? Because maybe the tax rates go too low. And we look at results relative to the baseline, and we ask whether this is sufficient to pay for benefits. This is eliminating tax Schedule A, and you would be on B. And actually, it looks like your high cost multiple would be greater than 1.0 going forward. But this is without any increases in benefit generosity. If we increase benefit generosity and we did that, it would not be sufficient. And benefits, the average high cost multiple would decline dramatically. How about taxing individual earners as part of this picture? The declining recipiency rate, many workers view it as welfare. They don't get involved. In New Jersey, the recipiency rate is the highest in the nation. It's 52% of unemployed workers in New Jersey receive unemployment insurance. Nationwide, the average is about 28%. People know that they've already paid into the system. They don't regard it as welfare. And we simulated a small tax. This is the lowest tax faced by any Maryland employer, 0.3%. And we applied to capped at the taxable wage base. In other words, if you hold multiple jobs in your state income tax, you'd get a refund for that second job or that third job, or if you switch jobs, or anyway, you paid more than 0.3 times the taxable wage base, the income tax system would adjust it at year end. And we find that on average, it would cost workers with the taxable wage base currently it would cost workers $22.28 yearly per earner. They would get more say in the system, and employers would recognize that workers are shouldering part of the burden directly, and there may be more harmony in improving policy going forward. That's a political question. I'm just giving you some results to ponder here. It would generate about $60 to $70 million per year in revenue. If you had an index taxable wage base at 25%, the average we simulate per employee would be $36.90. And the maximum that anybody could pay would be the 0.3 times that 25%, which would be about $45 in 2019. And it would generate $90 to $115 million. And what would be the revenue effects? So the baseline revenues are this, and then with the employee tax added in 2024, the baseline revenues would be this, and the increase are these. And we gave you the averages already. And the system, it would improve the financing situation. This is the revenues, the revenues. So we looked at how many people hold multiple jobs, and this is before and after. So there's about $10 million returned to workers in the 2019 scenario. And it would be about 20% of people would get a refund. The issues of improving access and integrity are certainly things that need to be done. The new Beacon computer system that you have and the systems for using Lexis and Nexus to verify identity are important and should be maintained. But there should be always easy online, telephone, and in-person claims available to improve access. Application experts should be available in offices and by telephone. And employers should provide information about how to apply when workers separate. This is something that is done in most countries, not done in the United States very often. Maryland could be a real leader in improving information to workers on the system. In terms of integrity, face-to-face should always be done. There were, situations where some states had hundreds of thousands overnight claims coming from foreign countries during the pandemic. And because people have direct deposits of their benefits and they can apply for benefits online, you can set up a computer program to actually make these applications with some stolen identifier numbers. At some point, face-to-face validation. And I must say that Maryland, among all the states that I've worked in, more than a dozen states, Maryland has one of the most extensive reemployment support systems of any state that I've seen. Everybody in Maryland who's on unemployment benefits gets either worker profiling services or reemployment and services and eligibility assessments. 50% of the people who are not awaiting recall to an employer or members of a union hiring hall where the union hiring hall does the job search for them, 50% of them all have their eligibility checked and a package of reemployment services. The other half who are not in that pool get worker profiling services. And I've sat through I've interviewed people that do that, and I know the components of the services, and I've seen the results. So Maryland has many integrity features in place, but some kind of face-to-face. When I first started doing this work back in the 1980s and 70s, actually, you had to actually go into the office, present yourself, and there was a teller window where they distributed cash payments for your benefits. We're a long way from that, but we do have tools like this, Zoom or FaceTime or something where integrity could be strengthened. And the possible funding sources that we talked about, tax base and a modest employee tax. These are some other policy options. I've gone through these and I thank you. We have some supplementary material, but I should let Secretary Robinson speak, and I thank you for your patience and interest.
Thank you. Before Secretary Robinson, Senator, I see we have one question. Delegate Charkoudian has a question on this presentation. Go ahead, Delegate, if you'd like to ask.
Thank you, Mr. Chair, and thank you for the presentation and for the extraordinary work that you've done over the last several months to do this analysis. I have a couple of questions. So the first is just kind of very broadly, I think that the legislation requested that an analysis be done of benefits and costs of increasing the benefits, of changing the benefit structure. So increasing maximums, also the income disregard, which you didn't speak as much about, although you did do that analysis in the report that we received earlier, and a few other pieces. So I think what you sort of did in your analysis was say, like, it is standard accepted that these are best practice standards, a benefit amount that's higher than what we currently do, more equity in terms of shifting from the 54 to 50%, either increasing the minimum disregard or either straight up or as a percentage, as several other states do. So you sort of said that's a standard, and then most of your analysis was the cost and how we could pay for it. And while I appreciate that, and I appreciate you establishing these as standards that we should strive for in the state, I do think it's important to articulate specifically why those increased benefits are the standard. And I'm wondering if you could just say a few words about the benefits to both the individuals, but also to the broader economy and to the localized economy in the community where people may have lost their jobs in terms of countercyclical effects, both more broadly and specifically in that community. Because I do think that while we're making some hard choices this year, next year, it'll be too easy to only look at the costs, which is kind of what a lot of what you sort of presented to us. And I think it's important that we also have this baseline of why those are considered best practice standards in the field.
Thank you. Those are excellent questions. First of all, about the wage replacement rate. The 50% has been a standard for many years, ever since Dwight Eisenhower enunciated it based upon surveys of people's living standards and necessary and obligated expenses. And there's been a lot of more modern research, including optimal models of optimal unemployment insurance, which come up to the same answer of 50% wage replacement. And the duration also, there's been studies on that. There's a whole volume. I did work for the National Commission on Unemployment Compensation, the Advisory Council on Unemployment Compensation. I'm participating in a panel at the American Economic Association on Saturday, where we have two papers that have received a lot of attention in the press lately. I'm giving a paper on equity in unemployment insurance across demographic and racial groups. Some of the colleagues on the panel are giving papers on the replacement rates that occurred under the pandemic. So like we said, I mean, Maryland has a 54% replacement rate below the maximum, and the average benefit was about $335. When you add the $600 federal pandemic assistance, the replacement rate is more than one on average. And the research on that was that during the pandemic, it didn't have a work disincentive. Although there's not a lot of research other than the 50% wage replacement. So both my colleagues, these are colleagues that one group is at UMass and Columbia and Harvard, and the other group is at the University of Chicago. And they're all looking at these extremely high unemployment rates in a period where labor demand was zero and the work search requirements were suspended. And they say that there was no real disincentive. We don't know that, but we do know over long term that you should try to get 50% wage replacement at least for 80% of the beneficiaries. And right now, Maryland is not very far from achieving that. A lot of states are much farther away. And we do know also that that during the pandemic, the injection of spending from the unemployment insurance program was incredibly important. The states, just in the 2020, the states injected through regular benefits about $100 billion. And the FPUC and all that added over $500 billion. And the multiplier, the income multiplier, is about 2. There's been a range of estimates, but it's about 2. So that was really $1 trillion stimulus. And it was to people who are working people who rely on income from their work, and it's spent immediately. It's not put into their investment portfolios. This is money that gets spent in the community and boosts the community. So there's a lot of evidence that the unemployment benefits are a real support to business in local areas and in the states. And thank you, Representative Charkoudian, for those questions.
Thank you, Delegate. I see we have Donna Edwards has a question.
Yes, thank you. Again, great research and a wonderful report. You spent some time on New Jersey, and also, you know, it's one of 2 states that does have a small contribution by the employee. You did not, though, discuss that in New Jersey, the taxable wage goes up to $32,600.
Yes.
And so, I mean, that's something, if we would be wanting to compare ourselves or do something in New Jersey, obviously we've got to look at increasing the wage base, the taxable wage. And also, I mean, their minimum is 120 a week. For maximum, the last I looked was like, I don't know, 713. So of course that adds to the buy-in, but at least having up to 32,000 or 36,000 actually, taxable really does help their whole UI. So we can't do one without the other at looking at these things.
I agree 100%, Ms. Edwards. We always talk about financing. And if you look, like I made the point, is that the states that have better financing have better benefits. And there's really 2 groups of states out there, if you sort them crudely. States that believe that unemployment insurance is a pillar of the labor market and helps people transition between jobs smoothly and not accept the first job and use their skills in the most efficient, successful place. And states that view unemployment as a business cost to be minimized and have eroded their unemployment safety net and have recipiency rates in the 10% range. And I think Maryland is closer to having a good system, and it could be, with some minor changes, I think, improved.
Thank you, Dr. O'Leary. Are there any other questions? Delegate Charkoudian, is your hand raised for another question?
It is. I'll ask just one quick question and then I'll follow up with Dr. O'Leary by email. How about that?
I'd love that. Yeah.
Can you, I have several other questions, but can you just speak to the AHCM? And I think I understand it as important in broad stability. Does it also affect the access to the interest rate at which we would pay loans back to the Department of Labor? And can you, I think it does, but I'm not actually positive. So can you just speak to that piece as we're looking at why we would want it to be above 1?
Yeah, in 2014, the Department of Labor put out a regulation that said, because you know, any state, if they run out of money, can borrow from the Treasury, and they pay an interest rate that's set by Treasury rates. And I think the rate is some like 2.2% now. It's much higher than the market rate of the municipal bond rate. the federal government put a standard in place that said, because they did some actuarial studies, and they said that states should have at least 1 year of recession level reserves on hand, and that will help them avoid borrowing. But if they have that level, the 1.0, that's 1 year of recession level reserves on hand, they can borrow interest free. And it's an interest free loan, and it lasts for the second January 1st. So it's kind of an option to have. So they created an incentive. They didn't create a conformity requirement when they did that. So that's the purpose. It's based on actuarial tables and they want the unemployment insurance system to stand on itself. It's self-financing, and it's separate from the other operations of the government. And you know, something that's happened is that, yeah, the federal government has become very generous in these recession periods. In fact, Ken and I did some computations recently where we looked at all the recessions in the past, 40 years, 50 years, and the share of total benefit payments that go out that are federal versus state in a recession has been increasing in recessions. And in this last, I think, Ken, and during this 2020, we found that something like 90% nationwide on average was federally paid. In the financial crisis in 08-09, I think it was like 60 to 70%. And in prior recessions, it was even less. And that reflects the posture that states are changing their programs to be more meager. Several states have retreated from the 26-week duration standard. And so their systems are less responsive. And maybe that's because they expect the federal partner to jump in. And I just don't think that that's a sustainable system. And I think the workers in the states with stronger unemployment systems. And the other thing is that those states that weaken their system, their economies tend not to snap back quite as fast either. They don't have that counter-cyclical stimulus that you mentioned. So thank you.
Thank you, Dr. Earlier. I see we have a couple of more questions. Mike Sires and then Kaylee Locklear, and then we'll go ahead and we'll take those questions, and then we'll go ahead and let Secretary Robinson do her presentation. So Mike, would you like to ask your question?
Sure. Thank you very much. And thank you, Dr. O'Leary, for a great presentation. I was curious if you had done any modeling for Maryland, or if you were aware of research just in general in other states on what the employment impacts would be from, both if there's an increase in tax payments by upwards of 20% on the employer side, is that going to potentially lead to a decrease in employment in the state? But then also if there's been any research done on if more money in the hands of workers is going to lead to kind of a balancing out. I know there's a lot of research on minimum wage impacts, pretty robust literature there. Might be analogous to this situation, but just wondering if you've done any work for Maryland, or if you're aware of any work that maybe we could use as evaluating this.
Mr. Sires, very good question. I have not done anything for Maryland on that area. I think probably the best evidence that we have are the states that have revised their financing systems. And the recent ones that I can think of, smaller states like Vermont and Connecticut. I mean, and in neither case did we see dramatic displacement effects. And a question that Representative Sharkoudian raised about increasing the disregard for part-time work. I think Oregon recently raised their disregard to $300 a week, which is a dramatic change. And I know Connecticut also changed it. And I've done some work on the partial benefit system. And one of the things you find when you do that is that the workers are more honest in reporting earnings, and the system has a better handle on the real level of labor market activity when that happens. So yeah, I haven't done anything, Mr. Sires, for Maryland, but those are some examples I think we can turn to, and we can check a little bit more into that after this meeting.
Yeah. Thank you. Appreciate it.
Thank you. Kelly Locklear. Kelly.
Thank you, Chairman Carey and Chris. Thank you so much for this presentation. Just because we have this opportunity with you to compare and contrast in a way that we typically don't have. Does Maryland not have one of the highest minimum unemployment insurance tax rates in the country, as well as one of the highest maximum tax rates in the country as well? So our
yeah, I mean, I can't argue with that, but the net effect is that the average tax rate, as a result of all the triggers and so forth, is in the lower third of all states. But let me make this point that the benefit of having a wide range, which was really from 0.3 to 7.5 on Schedule A, and actually up to 13.5 on Schedule F, is that it's more of a stronger incentive for employers to control the stability of their workforce, because there's a result. So I mean, that's the thinking. Now, in terms of the minimum, the 0.3%, that's a very low rate, but you're right. I mean, some states have a 0 employer tax rate, and those states typically have poorly financed benefits, and they have more restrictive access, and they have lower recipiency rates than Maryland has. So again, I think you need to ask what benefits, we're in a period of worker shortage right now, and what kind of a system is going to help employers succeed as well as workers succeed? And having the kind of reemployment services that are offered in Maryland, I mean, I don't think you have a lot of malingerers on the system, because there's no opportunity in Maryland to do that. People have earned it, and they're desperately trying to use the reemployment services between jobs. And there's some findings. In any kind of system, there should be some kind of minimum tax above 0, I would argue, so that at least people are paying attention. If the employer tax rate was 0 for all employers wouldn't be interested in this. But this is an important component of the benefit package that employers provide to workers in Maryland. Employers are providing insurance against unemployment. That's an important thing. And they shouldn't be shy. Employers should be proud of doing that, I think. So anyway, that's my take.
Okay, thank you. I see, Mike, we have one more question, Mike O'Halloran, and then we'll move on to the secretary.
Mhm.
Mike, you have a question? Mike O'Halloran?
Sorry, I forgot to take myself off mute. Finally did it. Thank you, Mr. Chairman, and thank you, Dr. Leary, for your hard work on this. I'll try and be as quick as possible. Certainly, we're just looking at one piece of the puzzle when it comes to the taxes and the cost of doing business in Maryland. Certainly something that all the legislators on this call are very familiar with. When my colleagues with retailers in the chamber go and talk before them, we can't just silo these things. Interestingly enough, I just saw a report come across that Maryland businesses ranked number 47 when it comes to business taxes. So that's very unfortunate. And here we are today talking about potentially raising yet another tax of doing business. Now, I understand your points about, this could actually in the long run help employers hold on to employees. But, have you contemplated, there's a lot of other studies out there that show, certainly throughout the course of this pandemic, that business owners, particularly SMEs, are raising total compensation on their own. So to be more to the point, I was interested going back to slide 13, where you talk about a regressive tax. talking about, in essence, the lower wages and let me read right from it. A low fixed taxable wage rate bears more heavily on employers paying lower wages and low wage workers. Was there any, you did such a fine job of explaining, the studies and the academics behind some other points. Is what's your rationale, or is this more editorial? I'm just trying to gather where that came from.
Well, it's just a principle of public finance. Thank you, Mr. O'Halloran, for your question. Yeah, it's just a principle of public finance. I mean, anything that it's like one of the reasons that you shouldn't have a sales tax on food. Food is a bigger share of the budget for a family with a lower income. And so as a consequence, it's regressive because it bears more heavily on the low income family. Same principle applies here. If only $8,500 is subject to taxation, and companies where the average wage is more like $50,000, or I think in Maryland the highest average wage, and we have tables in our report. I think it's about $45,000 or $40,000 was it for the one employee group, and then 38,000 and so forth. We have some tables there. It's just that it's not as big of an impact. So any change, whether the tax schedule shifts from A to B, if you're only subject to a smaller share, it doesn't have as much of an impact on other decisions in your life, right? When it's all your wages, and for example, the retailers tend to be lower average wages. Well, their response is smaller than the higher average wages. So
I appreciate it. I guess just the interesting thing there. I mean, it sounds like there may be a slight endorsement to get rid of the sales tax in Maryland. But
well, on food, groceries, that's a fundamental principle. Sure. I mean,
no, the interesting thing,
and a lot of states have a limit.
Unlike the sales tax, that we're talking about. I mean, those are, again, like you pointed out, paid directly by the consumer, whereas also, as you pointed out, here the UI tax is paid directly by the employer. But right. I know we've got to get to Secretary Robinson. Again, I appreciate your work and appreciate your forbearance there, Chair Carey.
Thank you. All right, so let's go ahead and get on to Secretary Robinson's presentation. Madam Secretary, go ahead. Thank you.
Good morning, and thank you. I do have just a few slides. So if I believe someone's going to share those, thank you so much. I will start out by thanking the co-chairs, Delegate Carey and Senator Klausmeier. It has been a pleasure, I will say, amidst everything that we have faced in this pandemic, to have the opportunity to meet so often with you over the last couple of years. And get to know you and partner with you in this crisis that hit the unemployment insurance system during the pandemic. I also want to thank Chris O'Leary and Ken Klein. You guys have worked with our department, not only on this study, but as Chris mentioned, with our workforce division and helping us to improve some of our reemployment strategies as well. So I'm very glad that you were available this morning to explain and answer questions about this report, because obviously you are able to do it much better and more articulate than I ever could. So thank you for that. I only have a few slides if we want to jump right into the first one. And some of these I'm going to go through quickly because they're highlights of things we have done, and some of you have asked me these questions recently. For example, the last bullet probably is the most important here, which you saw in the slides. As of January 5th, this is our Unemployment Insurance Trust Fund balance. I think everyone knows, kind of going from the bottom to the top, we added almost 2,300 new employees during this pandemic. They are still on board, working through every single claim that needs to get resolved. And we're making great progress, as I know the legislators on this call have experienced in working with your district case managers. We've paid over $16 billion in state and federal benefits. That's obviously a ton of funding. It is historic for the state of Maryland, as those payments going out over the country have been historic. We do have, and I'm going to talk towards the end a little bit more about what was in the study related to fraud, because we have flagged 2.3 million claims during this pandemic as fraudulent. That is also historic and something that I don't think the federal government or states ever anticipated. It's a new phenomenon that came, after the CARES Act and the federal programs. And the majority of that fraud that I'm talking about that was unexpected is, the fraudulent identities being used to file unemployment claims in Maryland. That's a very different type of fraud than states had dealt with in the past. I'm happy to tell you that at this point, Maryland has processed 99% of claims that we have received, complete legitimate claims, and that only leaves 1% of claims that have not received an initial determination. And actually the number is lower than what's on the slide. As of this morning, we're down right around 8,000 pending claims that are waiting for an initial determination. So we can go right to the next slide. Thank you. I'm really happy that Chris touched on these points as well, because I think it was important to remind the committee of the bipartisan agreements that were made last session from Governor Hogan and the leadership of this legislature. We were so happy to work together to secure that $1 billion infusion into the trust fund in 2021. It really helped stabilize our trust fund and put it where we are. And there's very few states actually where no other state used as much American Rescue Plan money for their unemployment insurance trust fund as Maryland. So we're really happy. I will thank our partners in the legislature for partnering with us on that. As you all know, Governor Hogan issued the non-charging experience rating executive order in the fall, and that was also turned into legislation in a bipartisan nature. Senate Bill 811, I'll give a shout out to Senator Hershey. I know you really took the charge there, and that ensures that our employers are held in Table C for 2022 and 2023. And of course, we offered very flexible employer payment plans and tax deterrent options, which many, many employers took advantage of. However, our employers came through and paid their taxes and their contributions through the end of the year. And that's one of the reasons our trust fund is strong now. So if we go to the next slide, I think I'm just pointing out the strength of our current trust fund. We can go right past this slide. This just explains the study that was required by legislation and the parts that were required to be studied by the Upjohn Institute and a few parts that were studied by our department, which we'll go through in a minute. Trust fund solvency. Chris did a great job of kind of highlighting this as well, but I wanted to just make sure, because when you hear my comments at the end of this presentation, and you understand why I'm doing this, I wanted to make sure that everyone noticed that in that chart, you will see that the trust fund is currently financially sound. And that really was due to the bipartisan actions taken in 2021, and because most employers paid their contributions in a timely manner by the end of the year. If you go to the next slide, please. This is the chart that you already saw. Again, I'm not going to explain it, but it does show that we are currently solvent. If we do nothing else, we remain solvent through 2025. And in fact, if we do nothing else, our employers, after the 2 years of legislatively being held in Table C, our balance in our trust fund will bring us back to Table A by 2024. So if you go right to the next slide, please. So I'm going to just highlight a couple bits of the analysis from our perspective at the Maryland Department of Labor. And notice that the central finding really is, suggested financing reform. I think that's what the legislature asked for. And I think Chris and Ken did such a great job of laying out all the data. I'm not arguing with any of that data. And some of the suggestions that they talked about were indexing the taxable wage base, This would account for a significant tax increase for Maryland employers, but that brings greater revenue to our unemployment insurance trust fund. The report does suggest that by indexing, the state might be better suited to maintain solvency into future years beyond 2025. And one of the charts that I think I have on the next slide I just wanted to point out that it represents almost a 20% unemployment insurance tax increase across the board on all employers. So if you go to the next slide. To continue this analysis, I know that this chart that Dr. O'Leary presented also shows that indexing affects small and medium-sized enterprises slightly more. Their average increase would be a little bit over 25%, which represents that additional $32 per employee. And my understanding is the reason that these are more severely impacted by this increase in the taxable wage base is because small and medium-sized businesses pay higher wages than the average employer. So you can go to the next slide. So there were a few standards in the study requested by the legislature that were more appropriate for our department to study internally. And so just as a reminder, we were asked to kind of look at standards for when an employee is entitled for benefits, including when they leave a job due to unsafe working conditions or guarding against unreasonable risks of infections. Obviously, we oversee labor and industry and workplace safety. When an employer is terminated for refusing work or for unsafe conditions, and when they decline to accept work for those conditions. So on the next slide, I walk through some of the ways that we have done that, and our report shows that generally, these type of standards are governed by unemployment insurance program letters. Those are what we call them UPLs. I know that the chairs have heard me talk about those many times. It's kind of a term of art in the unemployment insurance world from the federal government. This is the way that USDOL issues guidance and directives to states. So in those UPLs, USDOL issues all kinds of directives, guidance for our department to create standards in all of these areas. We conducted an intense review of every single standard and every single one of those USDOL directives that addresses any of these issues, and have kind of streamlined in any way we possibly can. We also have evaluated all the separations by employees' refusal to work because of any unsafe work conditions or unreasonable risk of infections on a work site. We do that typically but on a case-by-case basis as required by unemployment insurance program letters from USDOL. However, when we're evaluating whether a claimant has a good cause to refuse work due to any workplace hazards or safety issues, we always, and this is the last bullet on this slide, I wanted to point it out to the committee, we always give great weight to the guidance issued by all of the partnering agencies from the federal government, the CDC, USDOL, OSHA, and MOSH. Each of those agencies issues us guidance and directives continuously. And so those directives all go right into our standards. And that is really how we make those decisions on a case-by-case basis. You can go to the next slide. Thank you. I'm so glad that this study requested for us to take a look at fraud as well. Because as you know, this has been a problem that I don't think anyone anticipated was going to be so large. And it has been huge, obviously, across the country. And so one of the things we were asked to look at were existing fraud penalties. And as you can see in the last bullet, Maryland's fraud penalties have not been updated since 1986. The current penalties for committing fraud in our UI system are a $1,000 fine, 90 days in prison, and or disqualification from receiving unemployment insurance benefits. So if you go to the next slide. We think it's really important that these penalties are looked at in the future, but in order to deter and prevent fraud like this from ever happening again. You all know we've dealt with unprecedented fraud. The snapshot shows that during our pandemic, we received over 2.3 million claims that were flagged as fraudulent. and, are being investigated. And at about 1.5, 1.7 million of them have been confirmed as fraudulent. That's a really high percentage. And it has been a difficult task for our department and for the federal government. I think everyone knows that the CARES Act programs led to some of this uncertainty and some of this identity fraud, simply because of the way the programs were set up. Obviously, the plan was to get money out the door to claimants as quickly as possible. So when they made an entirely new group of Marylanders and citizens across the country eligible for unemployment that was not attached to wages and it was not attached to employer, the rules stated that a claimant could apply and estimate their income, which they did. And states paid based on estimated incomes. Then states were required to go back and verify the income and verify the employment, whether it be self-employment or a gig worker job or some other type of reason that they weren't eligible for regular UI, but they were still eligible for a COVID reason in the CARES Act. When we went back and started verifying all of that, many of those claimants had already been paid and were discovered to have been using fraudulent identities. So that is one of the reasons that the fraud kind of rolled into our systems and that it was so hard to track. There were lack of, I think it's something that the federal government didn't anticipate. And so there was a lack of, metrics and requirements to prevent that at an onset. So if you go to the next slide, please. I think you have probably all heard by this point that many of the entities that are being investigated and have been found to be committing this fraud are global, right? It's not only our own kind of prosecutions and indictments that we're working on. The FBI has created a task force. The Federal Department of Justice is on top of this. We are currently sharing our data in Maryland constantly with USDOL's Office of Inspector General through, of course, very tight MOUs and secure system avenues and pathways that our IT people can share that data. The National Association of State Workforce Agencies has also created an integrity hub, and states across the country have gotten together to make sure that we are sharing data and providing all of that information to the federal prosecutorial authorities so that they can cross-reference data and claims across the country in every state system in order to track down fraudsters. But the fact of the matter is that they are very difficult sometimes to locate and bring to justice. And so for that reason, this is why we think it's really important to take a look at the penalties in our system and even across the nation so that we can do something more to deter and prevent the fraud in the first place. So if you go to the next slide, please. I think this is my last slide because we wanted to leave a lot of time for discussion. So with everything that Chris and Ken have presented, and I know you all have hundreds more pages of those reports to sift through if you haven't read them already, it's such good data. And I want to make sure that we're really clear that we just wanted to kind of highlight and point out a few points from the study because one of the things that we did show is that the trust fund is solvent through 2025. And therefore we don't want to endorse any higher tax burden on our Maryland employer community at this time. And let me kind of explain my thinking here. And I hope that everyone will understand we're not where we thought we would be in 2022, right? We're in the midst of another surge. Our employers are having trouble finding workers. We have a serious labor shortage, and my workforce division, as Chris mentioned, is working very hard to reach out, to do assessments, to provide training and make sure every claimant in our system and unemployed individual across our state has access to all of our programs and training. We have an EARN program, we have the apprenticeship program, the list goes on and on. We have an interview module, we have resume assistance. we have hundreds of thousands of vacant jobs that we want to get people connected to. And so I have a whole part of the department that is all they're working on right now. And it's really important, and it will benefit not only the employees that are looking for these jobs, but it's going to benefit our employers who are having trouble filling their positions. Our employers, as was mentioned, are also already paying higher wages. We have set a higher minimum wage, but we also, because of the labor shortage, because of this pandemic, we have seen, and it has been proven, that employers are increasing their payroll and increasing their pay scales time and time again in order to try and attract workers. We're grateful to our employers for doing that. But we're still in the pandemic. We need them to emerge strong before we add any additional burden. So our recommendation is that the General Assembly really look at this data, which is complex and extensive, so that we can gain stakeholder input and talk about this a little bit and get through this pandemic, get through this surge, get to a point where we've got our workers back in the workforce, and at that time make considerations on how we institute financing reform. I will also mention, last year in session, we talked about suspending the mitigation language and potentially moving to a pay or deny model at least in times of emergency, to allow for expedited claims processing. I hope that that's something the legislature takes a look at this year. We are one of only 4 states that has mitigation language in our state statutes. And I've been asked time and time again, how we might expedite the claim processing, and that would be one of the best and easiest ways for us to do that in a future time of emergency. And then, of course, my last recommendation is to strongly consider enhanced penalties for fraudulent activity in our system. I don't think anyone can argue with the onslaught of fraud we have seen. It remains to be a problem. We hoped that the fraud would be reduced significantly with the ending of the federal programs. And it is reduced only because the number of claims we are receiving are reduced. However, these fraudsters have decided that it is still worth trying to find ways to attack our system. We actually have fraudsters trying to create dormant fake businesses so that they can attach regular UI claims to it. They're finding new ways to attack our system. The very good news is that we have LexisNexis now integrated into our beacon system, so we can catch fraudsters at the initial claim period. We will never be in a position we were in the future in terms of verifying identities. And so that is a really good thing, but the fraudsters are smart, and they keep finding new ways to try and get into UI systems. So I hope that is helpful. I'm obviously available to answer questions, as I know Chris and Ken are. So I'll stop there, and thank you for your time.
Okay. Do we have any questions? Before we go any further, I'll get you in a minute, Delegate Charkoudian, but how many, I'm trying to get my bearings on here. How many people have been found guilty and brought to justice? Has anybody had to pay the penalties or go to jail or anything over this?
That's a great question, Senator. As you know, Maryland Department of Labor is not the investigative or the prosecutorial authority. I do believe people have been, I know for a fact, people have been indicted across the country, including in Maryland. There have been stories, and we have spoken with the Office of Inspector General about indictments that happened in Hyattsville in particular. There have been Nigerian fraud rings that have been indicted. They're still working to kind of locate. I'm not the right person to give you the details on whether or not they're in jail. It is unfortunate, and the reason a deterrent and stronger penalties are so important is because I'm told that in these federal type of investigations where claims and fraudsters are attacking multiple states and some of the operations are happening globally, sometimes it takes years and years for those investigations to complete. So I certainly hope that they are all being prosecuted and brought to justice.
Okay, well, I would think that's one thing that we, Delegate Carey and I will be looking at. So for the future, and that's what we have to start looking into, the future of how things are going to be working 5 years from now or 10 years from now. And we need to think in the future, and we have to make sure that we're okay here too in today. And who knows what's going to happen in the future. 5 years ago, we would have never thought we were where we are now. So, okay, Delegate Charkoudian, and then we'll take Callie.
Thank you, Madam Chair. Thank you, Madam Secretary, for that presentation and all the work you've done over the last few years on this. I have, I think, one question on this presentation, and I'll hold the others for the next agenda item. And my question is just about, you talked about the employees hired and the contractors hired, and we've received reports that state employees under a collective bargaining contract who should have received overtime instead were offered jobs sort of on the side through the subcontractors or as contractors in violation of their collective bargaining agreement, instead of being given overtime for the additional hours worked because they did have the expertise in the areas that were needed. And I'm just wondering if you could speak to that.
Sure. I don't have that response in front of me, but I know we sent the response that was provided and approved by our HR and Administration Department and Department of Budget and Management back to AFSCME and the entity that wrote the letter. So we disagree with the analysis in their letter. We don't believe there was any violation whatsoever. And more importantly, we have paid more overtime in the course of the last year than probably in the history of the entire department. Our unemployment insurance staff has been on mandatory overtime for almost 2 years. And many of them have had the flexibility to work more than the mandatory overtime hours in a time of emergencies to help us get through this crisis. What we did was offered to additional division workers the availability, if they wished, to be trained and help with some of the additional work. And I can tell you that the employees that stepped up to do that, to go through the training and take on that additional responsibility and be compensated for it, we're grateful and have asked for some of those responsibilities to continue, even though some of them are being pulled off certain projects to go back to their regular jobs. It was all over and above the work that they were doing, and they were compensated appropriately.
Okay, I have some concerns about that. We can continue to follow up. I do think that the response that we received didn't sufficiently address the issues that were raised and the interest in the union in discussing corrective action. So I'll follow up separately because I think there's a number of other issues that we also need to discuss today.
Sure, I'd be happy to meet with you separately about that, and we can probably include DBM.
Okay, Delegate Charkoudian, you're finished. Callie.
Thank you, Madam Chair. Thank you so much for that presentation. So I think what's interesting is, according to Pew, in 42 states, including the state of Maryland,
You're breaking up. You're breaking up a little bit.
Can you hear me? My apologies.
That's okay.
All right, so let me say it again. So according to Pew, in 42 states, including the state of Maryland, there are actually more jobs than jobless people. And so in reading report 2 that you discussed, the study acknowledges that an increase in benefits results in UI recipients staying on longer. And you talked about that a little bit. So with a labor shortage, can we extrapolate that doing so is going to make this situation worse for employers?
So I'm sorry, Kaylee, can you repeat your question? I'm not sure I quite understand your question.
I think I know.
The question is, and I think you talked about this
I know
a little
where
bit.
Kaylee's coming from. Sure. I mean, there's, it's a core problem. I mean, look, number one, unemployment insurance exists to provide partial wage replacement during involuntary unemployment while people are trying to get back to work. Maryland does a good job of assessing who's eligible. There's been some problems during the pandemic, and also providing reemployment services. But the question is, what is adequate and what's excessive? What we're suggesting is that Maryland maintain its replacement, or maybe even slightly reduce it as part of a package to improve the system. And sure, if you do increase benefits, you're going to have some disincentive effects. They're not enormous. A 10% increase in the replacement rate shortens duration. On average, estimates are between half a week and a week and a half. And the average duration is about 15, 16 weeks. So it's a fraction. So it's a question of providing this needed income replacement and stability for the macroeconomy with the lowest efficiency loss. And let me address a couple of related points here. And I think Mike O'Halloran raised this, and it seems to be underlying. Okay, the committee, I think the questions that were raised about the adequacy of the unemployment insurance benefits in the state were good questions. We tried to answer them with what are the standard accepted rates? And we tried to look at the financing. And the question is, I mean, we all know that jobs are created mainly by the private sector. And we want an environment where private sector employers can thrive. And we don't want to unnecessarily burden employers, particularly at the wrong time in the business cycle. The question is, we want an improved unemployment insurance system. It's going to cost a little bit more money. We know that it's out of step because, as the Secretary Robinson said, workers' earnings have risen. That means that if they do happen to lose their jobs, their replacement rates are going to be even lower with a fixed maximum. So we're trying to think about ways to keep the system in step with progress. And the question is, when do we raise tax? Now, if we look back at the recovery from the financial crisis, 08, 09, 2010, those were hard years. The current system actually responded very quickly to raise the tax schedules. Was that too quick? Maybe. And the kind of reforms that Ken and I simulated we're not saying do it overnight. We're saying maybe do it in 2023, 24, 25. You could make a glide path to improvement. I think this is not a big bang, not a situation where you want a big bang and have a big dislocation. You don't want to do that. You want to have a glide path toward improving the system. And there's been some recent papers that say, the way that the experience rating systems now and the triggers work, a little bit too quick. They choke off hiring maybe a little bit during the early phase of a recovery. Well, like I said, if you look back to the financial crisis that happened in 08 to 2010, when was the right time to maybe raise revenue? Was it 2016? No, nobody wanted to do that. It was too soon. What, 2017, was it too soon? No, 2018. Well, when the pandemic hit, it was definitely too late. But so the question is, when do we know it's the right time to do that? And I think we know that there's going to be a recovery. The recovery seems to be pretty robust. And I think it's a political question, but it's also based on the facts that we're trying to provide. You have to make the judgment. How well do you want to accommodate workers in job transitions in terms of income replacement for households in Maryland? And when do you want to start improving the system in terms of those benefits and the financing to pay for those benefits? So, yeah, those are some of the points. Thank you.
Okay, I think Delegate Carey has a question.
Yes, thank you, Chairman Klausmeyer. I do have a couple of questions for Secretary Robinson. Madam Secretary, when you were talking about in the early part of your presentation that 99% of the claims received have been processed and received an initial determination. What I was wondering is when you say an initial determination, I'm wondering, and you probably don't have this number, but if you can get it for us, an initial determination. So how many people received an initial determination but are still waiting to get their benefits? We continue to get calls about, people who've kind of fallen into the black hole. And so I'm just trying to get an idea. Okay, so I've got an initial determination, but, are they still waiting? Do we have a number?
Sure, I don't have that number at my fingertips, but you're absolutely right. There are many claimants that receive an initial determination and receive payment. There are many claimants that receive payment for many, many weeks. And then based on a question that they answer in their weekly certification, remember the system is set up so they're essentially filing almost mini claims every single week, if you will. They have to answer a course of 10 questions to confirm their eligibility every single week. Any question they may answer, or they may not be monetarily eligible for that week, which is different from the week before. Or an employer may report something to us about that claimant, that they refused an offer to come back to work, or whatever it may be. Those are issues that would put a claim on hold and stop payment. And absolutely, those are things we are still working to resolve. There are some claimants, I don't have the number for you right now because it changes. The reason these numbers are so hard to get is because they change every single week. They fluctuate with every single weekly certification filed. And those queries in our system, on the IT side are more complex than you might imagine. So a claimant might only be waiting. They might have been completed their claim, but they might be calling your office because they believe they're entitled to 1 or 2 weeks in which they did not receive payment. And our team is still working to get through all of the processing to resolve the dispute with an employer on that 1 or 2 weeks. That's an example.
Okay, so yeah, if you can get that for us, because I guess my concern is just making sure that those people that or do something are getting them. And what we continue to hear is that, they still can't get in touch with anybody. And a lot of this is if they could just get somebody to kind of tell them, here's where we are. So we continue to hear that. But let me say this, I will say that you and your staff, Andrew, and the case, they do a good job at kind of helping all of us navigate this. But again, these are that small percentage of people that just can't see, we're trying to get them resolved, get them paid if they deserve, if they are entitled to their payments. And the other thing, if you could look into this for us too, is that we sometimes get concerned that there are branches within the department that are siloed in that they don't talk to one another, that they can't talk to one another to help resolve these claims. And what I can do is I'll get Patrice to talk with Andrew about some specifics, and he's probably aware of some of the specifics. But again, I was hoping, again, we've just come through this last 2 years of, hopefully we'll never have to do it in my lifetime again. But again, I just want to make sure that, the lines of communications, that staff can talk to staff, they can reach one another and help these caseworkers and managers make these decisions so that people who are entitled to benefits just get their benefits. I just want to make it so that it's an easier transition for these people and that they get to talk to somebody and that somebody can tell them, here's what's going on with your case.
So Delegate Carey, in response, I just wanted to mention that we want the exact same thing as you do. And we were hit with a situation which I would call the perfect storm, a year and a half ago, 18, 19 months ago now, where the number of people funded by the administrative grants from USDOL to manage the unemployment insurance program was the lowest it had been in a decade based on the federal funding model. When unemployment rates are low and the workload is low, the funding to administer the program is equally low. That's not my choice. I didn't put those rules in place. We have actually worked with Senator Klaus Meyer and proposing some ideas to work with our federal delegation into Congress and our national association. I think Chris O'Leary has been involved in some of these conversations as well. We do believe that there needs to be some reform at the federal level for this program, for exactly situations like this. That being said, as we hit the crisis and had to start hiring, and we were given flexibility by the federal government to use vendors to do some of the work, you might imagine it's impossible to train thousands of people on all aspects, from tax to employer disputes to the new PUA 10 CARES Act programs. It's impossible to train that many employees in a matter of days and weeks on all aspects of a complex program. So we did, unfortunately, had to do what I wish we didn't, was train certain groups of people on certain things to handle them. And at this point, we have so many of those employees cross-trained, and we have created open portals. Our district case managers have direct access to the benefit payment control fraud unit and to our adjudicators. And we've kind of tried as best as we possibly can over the course of time, and as we have gotten people cross-trained, to add those lines of connectivity, like you mentioned, so that someone can get their claim resolved issue. And we are answering every call. The only day that we're having a little bit of trouble still answering phones is Mondays on our highest weekly certification day, which makes sense. But we're getting there. We're making progress, and I can assure you we will get through it in this year, 2022.
I know we'll get through it, but like I said, I'm continuing to hear that people are siloed, and all I'm asking is that I know that we've been through this, all of the training. I know the difficulties that you faced, and but we'll get with you. We'll give you some specifics. Want you to look into them for us, because if some of the staff is feeling like, oh, I can't talk to that person, that's not what we've done over the last 18 or 19 months. You've opened it up, you've cross-trained them, you've allowed them to work between these silos.
Correct.
And I'm not sure that some of them are getting the memo. So you may have to do some reinforcing with the staff. So I appreciate that. And I guess the other question that I had was really for Dr. O'Leary. Two things for him. Real quick. First of all, Dr. O'Leary, and you know what, Madam Secretary, you might know, and you just brought this up, and that is USDOL looking at ways to change their part of the unemployment insurance system? Are they doing anything?
I'll let Chris, I'll let you follow up. We know we have had many conversations with, I had the conversation with Secretary Walsh at an event before the holidays. We have had conversations with members of our federal delegation. We do believe they are looking into it. They are still focused on fraud and like emerging from this pandemic and getting states back where they need to be. There are still a lot of issues, I think, from the current crisis that they're focused on. I can't dare speak for what they're planning to do or not, but we certainly hope it's something they're looking into. We know we've brought it to their attention.
Yeah, and I know because we've talked about this, and I know that, but again, having not heard anything, don't know. I mean, there are a lot of areas where the federal government should be doing things that the state government has stepped up to do, not only in unemployment insurance, but other areas. So I was just wondering if either of you had heard anything about that. Dr.
Secretary Robinson knows that the Department of Labor has created some special teams for outreach to states. One is to improve management, the Tiger teams, they call it, and they're working with groups of states. Maryland actually has a very well-developed IT system, and probably, it will be one of the bundles of states to be one of these management help that DOL is putting out at some point. But I think you're right. I mean, there's a problem with the, Secretary Robinson said there's a problem with the administrative financing model and the fact of really maintaining sufficient strength among workforce professionals. It has to be improved so it can be a quicker response during crisis periods. There is, at the federal level, there has been some legislation. I think the last version I saw was by Senator Wyden, and he did have in that some guidelines for states in terms of easing application for benefits. The CARES Act even had rules that states had to have at least 2 means of applying, online, by telephone, on paper, something. And usually it's, make sure that people don't wallow. These points, Representative Carey, that you raised about the system, I think Secretary Robinson has identified it. I'm not an expert on the difference between a mitigation model for eligibility decisions and a pay or denial, but I think some effort needs to be put into that to simplify things for Maryland. I agree completely with Secretary Robinson on that. Like I said, I think the Maryland system is very close to being an ideal system, and the steps to improving it are really should be considered as incremental, not just major changes. And so, thank you.
And I'm glad that you went there, because that was my last question, because you had said that in your presentation earlier. And, so what I was saying was, you said we had a good system, we could make it an ideal system. So with what you've done with this report that you've done, Madam Secretary, could you summarize, at least for us in the legislators, kind of, and not today, but as you're finishing up completing the study, could we get an executive summary of those things that you all recommend that we could do to make it an ideal system? This is good, this is great, or whatever, ideal. If you could give us your recommendations summarized, that would be very helpful for all of us, especially as we get into the session next week.
Absolutely. I'm happy to do that. Delegate Carey, I'll follow up.
Great. Thank you. Thank you, Madam Chair.
We have to work together on this, and that's what we've always said. So that, again, looking into the future, what we need to do, I think that's of utmost importance. So
agree.
And I see there's 2 hands up, and we're starting to run out of time. So Donna, you want to?
Well, thank you. And Secretary Robinson, thank you. Mr. O'Leary just brought it up. I had a follow-up question on mitigation, since you brought that up. What triggers mitigation? What is, the basis for most of it? And what percentage of our cases have to have mitigation?
Sure. Thank you, Donna. That's a great question. I don't have the percentages in front of me. I can certainly ask our team and see if we can pull that for you. But what triggers mitigation is when a claimant submits a claim in the regular UI program, and then an employer submits conflicting information or a dispute, if you will. So in a pay or deny state, the adjudicator looks at the information provided, and sometimes there might be some clarifying questions, but for the most part, they investigate the claim based on the information provided by the claimant and by the employer, and they make a pay or deny determination. Those cases that are disputed have to be adjudicated as required by USDOL. So that's how pay or deny states work. In a mitigation state like us, North Carolina, Alaska, I can't remember the other 2, we are required to do more in-depth investigation, if you will. That's really the easiest way for me to explain it. We are required to ask additional questions to dig deeper. For example, if an employer states that this was not a voluntary quit or a termination. This was they violated a employer policy, and therefore they were terminated for violation, and the employer feels like they were allowed to terminate and should not be required to pay benefits. A mitigation investigation might include questions about that policy, questions about if it was, detrimental to, or if there were any other alternatives, for if the employee was given alternatives. We have to dig deep and find ways to pay, if anything, partial benefits, or maybe we can issue a penalty to the claimant, but we are still trying to find a way, if at all possible, to award benefits to that claimant. So there's probably better ways that our legal team would explain all of those laws that have been in Maryland for so many years. But we asked last session, and I know we were in the midst of, a more intense crisis. Maybe this year will be an easier time for the legislature to kind of reevaluate those laws. And really, what we would ask in particular is that an evaluation of those mitigation laws that makes our process more lengthy, at least to be looked at relaxing in times of emergency, to help the agency be able to make a pay or deny decision more quickly to benefit the claimant and the employee to receive benefits. And of course, remember, if there is a denial, the claimant would also have faster access to the appeal process.
Okay.
Can I make a quick point on this, Senator Klausmeier?
Well,
point. I know you're running out of time.
If it's quick, because Delphinian's had her hand up.
But Secretary Robinson talked about a pretty big deal about going from a mitigation to a pay or denial. Let me suggest a middle ground. If you went to a pay or denial, but also introduced a UI advocates program. In Michigan, we have a UI advocates program where the state agency will pay a lawyer fee for either the claimant or the employer. Things get bogged down when the information is not complete to make a decision. By including an attorney or a qualified trained representative, maybe a former employment service employee who knows the system, can assemble the facts and make the decision clear. I think there's a fixed fee. I think it's about $125 per case. And, a claimant, when these hearings happen, so it's after the initial decision, which could be done under a pay or deny system. If there's an appeal, both sides could have representation and it could be a cleaner process. And, it's done here in Michigan. It's a model system. And I think you could meet with the people in the agency and learn something about it. So thank you for letting me.
Okay, thank you, Chris. Delegate Charkoudian.
Thank you, Madam Chair, and thank you, Madam Secretary. There's a number of things that I think we need to continue discussing either with the Oversight Committee or in some other group. I'm concerned about compliance with a number of the laws that we put into place last year. And some of that is just really basic stuff that I think is very much within the control of the department. Such as the data that is supposed to be transparent. This is some of what Delegate Carey was asking for. Delegate Carey and Senator Klausmeier's Bill 1138 requires data on the website. There's a lot of data that's still missing with references to suggesting that MDL doesn't know what the intent of the legislation was, which is disappointing because MDL was involved in all of the conversations about the legislation. And so if we were putting into legislation a term that doesn't have a legislative meaning, that would have been the time to share with us that it doesn't have a legislative meaning, not to subsequently post on your website that you don't know what we were talking about last year. So that's really disappointing. But then on top of it, there's blank spaces on this website that was created in response to 1138 of data that you report regularly to the U.S. Department of Labor. So on the U.S. Department of Labor site, I can see an answer to Delegate Carey's question, which is that in November, 24% of claims were paid within 21 days. as opposed to the federal requirement of 87% and the state's requirement of 92%. So that would be 76% of 5,000 that weren't paid in that time frame. So Delegate Carey, you and I can do the math on that at some point. In October, 22% were paid in that time frame. In September, 43% were paid in that time frame. So what that means is a number of things. I mean, that is disappointing, even though we've gone down to when we were doing 48,000 claims, that might be more explainable. You had 5,214 claims in November. But I think what's even more disappointing is avoiding putting that in a public place when the legislature asked that it be put in a public place. So instead of the section on the website that is number of claims for which payment was not made within 21 days, the Department of Labor's website says processing data on weekly reports, but doesn't put the number there. If one goes and hunts on the US Department of Labor website, the number is there because you're required by federal law to report it to them. So I'm sorry to end this way because I really want to talk about what is it you can do to come into compliance with all of the legislation that we passed last year. But this seems like an example of a really simple compliance issue, not one that requires catching up more time, the US Department of Labor to have to change how they fund administration. It just requires a desire to comply with the law that we passed. And so my request is that you update the website that was required under House Bill 1138 as soon as possible, especially with all the data that currently exists. And then if you have questions about what the legislature meant on some of these other areas, you know, we welcome the conversation so that those can be updated as well.
Thank you, Delegate Charcuti. And I would be happy to sit down with you individually or with the committee chairs at a future time. I know we're running out of time. I'd love to talk about all of these issues. Some of the terms that were used in the website data page are undefined UI terms, undefined terms in our system. So we were not aware of those terms being used in the legislation until it was passed. And so that's why we communicated that at that time. The numbers that we are updating in the system may not be listed because we are currently in the process of working very closely with USDOL to revise some of those numbers based on backdating and other reasons, working through our backlog so that when you resolve a claim in a backlog, it presents itself differently in timeliness standards. But like I said, we're happy to meet with you and walk through all of that. And I'd be glad to set a follow-up time.
Okay.
Are there
All
any other questions? I know, you know, we've been, we're going a little overtime, but it's been very beneficial. If anyone, session is just around the corner. And if anyone has any thoughts of any legislation, I don't know, Senator Hershey, are you still here? Oh, there you are. I can't find it. And Senator Benson, are you still here? But how about if, and I'm just saying this from the Senate side, that we get together and sit down and see what we can come up with. So, and I would just like to say that Evan, who has been the rock throughout the last 2 years, as far as unemployment, has left my employment. So I don't, Sam is listening in, and it's very important that he gets as much information as he can. So,
Senator.
Delegate Carey.
Yeah, can just before we leave, yes, the same Delegate Charcuti and I are already knowing that we're going to get together and talk. But let me just say, first of all, thank you to the Secretary. Thank you to Dr. O'Leary, Mr. Klein, for the presentation today. I thought it was, for at least from my perspective, it was a very informative, very well thought out. I still have some other questions that we'll get together and talk about, but I just wanted to thank you. But I also wanted to note, Erica White. Erica, can you, as Senator Klausmeyer pointed out, Laura Addis, our counsel, is leaving us, going on to another job, and Erica White is going to be the new Laura Addis. She's going to be the counsel. We look forward to working with her. She worked on unemployment issues for the committee in the early 2000s, I guess. I can't remember the date, hey, that's what happens when you get old. But we welcome her. We look forward to working with you. So welcome, Erica. Just want everybody to see Erica. So again, Madam Secretary, Dr. O'Leary, Mr. Klein, thank you from us, and I'll turn it back to you, Senator.
Okay, I just want to thank everyone for coming, the business, labor, and that's what we need to do is put our heads together and really, as I keep saying, is look to the future to see where we're headed, and in case another pandemic comes along, that people are prepared for it. So, and who would have thought we would be into the third round of the pandemic? So. All right. Thank you all for coming, and Happy New Year. We'll see everybody in Annapolis next